F. Calculate the effect on income and assets of using different inventory methods. In periods of rising prices, FIFO produces higher income and higher ending inventory. Lower COGS increases gross profit and net income, while inventory reflects recent higher costs. This improves profitability and liquidity ratios but may increase tax expense and inflationary periods. LIFO produces lower income and lower ending inventory. Higher COGS reduces gross profit and net income, lowering taxes. However, inventory may be significantly understated compared to replacement cost, weakening asset-based ratios. Weighted average produces results between FIFO and LIFO. It moderates the impact of price changes on income and asset valuation. In deflationary environments, the effects reverse. FIFO produces lower income, while LIFO produces higher income. G. Analyze the effects of inventory errors. Inventory errors affect both the balance sheet and income statement. If ending inventory is overstated, COGS is understated, and net income is overstated. The opposite occurs if ending inventory is understated. These errors distort gross margin and profitability ratios. Errors reverse in the subsequent period if not corrected. An overstated ending inventory in 1 year becomes an overstated beginning inventory the next year, causing COGS to be overstated and income understated. Over 2 years, total income is correct, but period-specific results are distorted. Inventory errors also affect working capital and retained earnings. Overstatements inflate current assets and equity, potentially misleading users about liquidity and solvency. Accurate physical counts and cutoff procedures are critical internal controls. H. Identify advantages and disadvantages of different inventory methods. FIFO advantages include realistic balance sheet values and simplicity. It reflects recent costs in ending inventory and aligns with natural physical flow for many businesses. However, in inflationary periods, it increases taxable income and may overstate profitability. LIFO advantages include tax savings and improved income statement matching. It matches current costs with current revenues during inflation. Disadvantages include outdated inventory values, complexity, and potential LIFO liquidation distortions. Weighted average offers stability and ease of use. It reduces income volatility but may not reflect current cost trends as accurately as FIFO or LIFO. Specific identification provides precise matching but is impractical for homogeneous goods. 1. Recommend the inventory method and cost flow assumption given a set of facts. In inflationary environments with tax minimization objectives, LIFO may be preferred. It lowers taxable income and better matches current costs to revenue. However, companies must consider potential impacts on financial ratios and investor perceptions. When financial reporting transparency and stronger asset valuation are priorities, FIFO is often appropriate. It produces higher income and more current inventory values. This may benefit companies seeking financing or strong earnings presentation. Weighted average is suitable when price volatility exists and simplicity is desired. The recommended method depends on industry characteristics, tax strategy, financial statement objectives, regulatory environment, and management's long-term reporting goals. Consistency and comparability must also be considered. J. Demonstrate understanding of debt security types, trading, available for sale, and held to maturity. Trading securities are debt investments acquired for short-term profit. They are reported at fair value on the balance sheet, and unrealized gains and losses are recognized in net income. Because changes in market value affect earnings immediately, trading securities increase income volatility. Interest revenue is recognized in income as earned, consistent with accrual accounting. Available for sale, AFS, securities are not classified as trading or held to maturity. They are also reported at fair value. However, unrealized gains and losses bypass net income and are recorded in other comprehensive income, OCI. These amounts accumulate in equity until realized through sale. This treatment reduces income volatility compared to trading securities. Held to maturity, HTM, securities are debt investments the company intends and is able to hold until maturity. They are reported at amortized cost rather than fair value. Unrealized gains and losses are not recognized. Interest income is calculated using the effective interest method, systematically amortizing discounts or premiums over the life of the security. K. Demonstrate understanding of the valuation of debt and equity securities. Debt securities are valued based on classification. Trading and AFS debt securities are measured at fair value, while HTM securities are carried at amortized cost. The effective interest method allocates interest revenue over time, adjusting the carrying value for discounts or premiums. Fair value adjustments for trading affect income. For AFS, they affect OCI. Equity securities with readily determinable fair values are generally measured at fair value through net income. Unrealized gains and losses are recognized directly in earnings. Dividends received are recorded as dividend income. This approach increases income volatility but reflects current market conditions. Equity investments without significant influence are reported at fair value when available. If fair value is not readily determinable, cost minus impairment may be used. Investments with significant influence, typically 20% to 50%, apply the equity method, recognizing the investor's share of the investee's net income rather than fair value changes. L. Determine the effect on the financial statements of using different depreciation methods. Depreciation methods affect timing of expense recognition. Straight-line depreciation allocates equal expense each year, resulting in stable net income. Accelerated methods, e.g., double declining balance, recognize higher expense in early years and lower expense later, reducing early period income but increasing it in later periods. Asset book value declines at different rates depending on the method used. Accelerated methods reduce carrying value more rapidly, lowering total assets in early years. Straight line produces a gradual reduction. Although total depreciation over the asset's life is the same, interim financial ratios differ. Cash flow is unaffected by depreciation method selection. Depreciation is a non-cash expense. However, taxable income may differ if tax depreciation differs from book depreciation. Method selection influences profitability ratios, return on assets, and asset turnover measures.